How to approach trading. Stock trading is a lot like surfing. How you see the market, how well you feel it, or how well you can synchronize yourself with it will determine how good of a trader you're going to be. The stock market is like an ocean. It's vast and complex. It's also cyclical. It has tides and currents. You'll learn how to recognize them so you can ride them, like a surfer rides a wave. No one can overpower the ocean, and you cannot move the market. You synchronize yourself with a perfect storm. Look for signs that the storm is coming. Note the times during which it happens. The market is cyclical, so come back and trade during that time again. Because there are so many ways to approach stock trading, any advice or opinion you receive will work for some and destroy other strategies. Everything becomes half truth and half lie. Keep your stop losses tight or loosen them up. Use a stop loss or not. Who knows? I've heard successful traders give contradicting advice many times. The only way to know something for sure is to witness or experience it, and you will have to answer many of the questions yourself to become a trader. Now, I cannot speak for all strategies out there. It takes traders a lifetime of work to perfect their market approach. And that's just one approach. Everybody trades differently. Even two people trading the same exact strategy will have different results. I will walk you through the development of my trading strategy over 15 years and my personal vision of the market. It took me a long time to become profitable. Some people are much better suited for trading than others, but let's not focus on them. An average human being will be chewed up by the market many times before they become consistent with their gains. I don't mind sharing my knowledge because it's almost impossible to copy a trading strategy. Think of surfing again. You can learn from the world's best surfing champion, and even if he answers every question you have, you will not become him, but you can improve. So let's go over the steps that I took so you can better understand how to develop your own way of trading stocks. How to approach trading. Stock trading is a lot like surfing. How you see the market, how well you feel it, or how well you can synchronize yourself with it will determine how good of a trader you're going to be. The stock market is like an ocean. It's vast and complex. It's also cyclical. It has tides and currents. You'll learn how to recognize them so you can ride them, like a surfer rides a wave. No one can overpower the ocean, and you cannot move the market. You synchronize yourself with a perfect storm. Look for signs that the storm is coming. Note the times during which it happens. The market is cyclical, so come back and trade during that time again. Because there are so many ways to approach stock trading, any advice or opinion you receive will work for some and destroy other strategies. Everything becomes half truth and half lie. Keep your stop losses tight or loosen them up. Use a stop loss or not. Who knows? I've heard successful traders give contradicting advice many times. The only way to know something for sure is to witness or experience it, and you will have to answer many of the questions yourself to become a trader. Now, I cannot speak for all strategies out there. It takes traders a lifetime of work to perfect their market approach, and that's just one approach. Everybody trades differently. Even two people trading the same exact strategy will have different results. I will walk you through the development of my trading strategy over 15 years and my personal vision of the market. It took me a long time to become profitable. Some people are much better suited for trading than others, but let's not focus on them. An average human being will be chewed up by the market many times before they become consistent with their gains. I don't mind sharing my knowledge because it's almost impossible to copy a trading strategy. Think of surfing again. You can learn from the world's best surfing champion, and even if he answers every question you have, you will not become him, but you can improve. So let's go over the steps that I took so you can better understand how to develop your own way of trading stocks. How stocks move. All stocks trade differently. Stocks have personalities. Some are volatile and some are not. Some trade in large volumes and others do not. There are moments during which a stock is more likely to trade one way or another, though. Most of the time, most stocks do not have an obvious direction. Technical analysis will keep telling you that a stock should go up, but as soon as you enter, it will do the opposite. Why? because someone has more information than you, or they have more experience, or a larger account. It doesn't really matter. The stock is constantly alternating between looking like a sell and looking like a buy. That is what the market is designed to do. In most conditions, you cannot predict the direction with high enough probability by looking at charts. Look at another chart of Facebook stock. It tries to break out and rally several times but fails and sells off. Trade as little as possible. Imagine there are three setups in three different stocks. Two of them have a 55 to 60% probability of working out, and the third one has an additional indicator pushing its probability to become a successful trade to 80%. Mathematically speaking, you should trade all three stocks, but if you disregard the two stocks with lower probability and trade only the stock with an 80% probability, your account will grow faster even though you are trading less. Every losing trade costs more than you estimate it to cost. Slippage, when you get a worse cover price because the market moved fast, commission fees, etc. I also realized that often while I was focusing on a trade with lower probability because its entry signal happened first, I would miss on the setup that had a higher probability, but required a little more patience and stalking before the entry signal occurred. I realized that the best approach was to narrow the stocks to be traded on any day to just one. The best stock has the greatest number of indicators aligned. Everything else gets discarded. For me, it was the stock that had traded many shares by the time the market opened. It indicated that it would have the necessary energy to move in one direction or another. It would not just stall or reverse the moment I entered a trade. Look at the chart of KKR stock. You can see on a daily chart that today's volume is much higher than the average volume. The daily chart also confirms the uptrend. As a result of this, the stock also moves up very nicely on a 2-minute chart, making it perfect to put on a trade. The second indicator for me was the price movement in either an up or down direction. Just because the stock has volume does not mean it will move in either direction. Some of the cheaper blue chip stocks trade in millions of shares, but the price often does not move much in either direction. For price to move, there must be imbalance between supply and demand. One side needs to be more aggressive, otherwise prices will just move within a narrow range. It is called consolidation or distribution. It happens at strong support and resistance levels. Imagine two large, equally strong armies clashing in a battle, and neither one of them can gain any ground. What you want is a stronger army to collide with a weaker army and reclaim ground by pushing the weaker army back. In a stock market, it will be the price moving in one direction or the other. You want to be on the side of the stronger army, so you buy if the price is moving up and sell if it is moving down. I would look at the stock with high volume at the market open and trending up or down, and look for an entry in the direction of the trend. Not always in the same direction though. Sometimes a stock will reverse and you must realize it as quickly as possible. Look at the chart of CERN stock. It has excessive volume. It breaks out to the upside but gets sold and reverses. If you look at the monthly chart in the top right corner of the image, you can see that the stock ran into resistance around the previous highs of around $66 to $68 where sellers came in. Sometimes a stock would gap at the market open, but instead of continuing in the same direction, it would reverse sharply. Does it mean that this is a bad strategy? Not at all. It just proves that in the stock market, everything is based on probabilities. High volume means that the stock has power to continue. Price change means that there is a disbalance in supply and demand. However, if it runs into a level that is too hard to break, it can reverse and use some of that volume to push in the opposite direction. How do you handle such a trade? If after you enter a trade in the original direction, your stop loss gets triggered, exit the trade. If the volume remains high, keep watching the stock. Aggressive traders sometimes reverse their trade if the trade in the original direction didn't work. Be careful, because it is one thing to exit a losing trade, but it is an entirely different thing to immediately enter another one after a loss. Psychologically, you're a lot closer to being on tilt, a situation where your decision-making becomes compromised. You might end up flipping the direction of your trade multiple times. and losing more or completely losing control and letting a bad trade run against you much further than your stop loss. The solution is to give it just a little more time after you exit to confirm that the direction of the trade has in fact reversed. Find a good entry with a new stop loss. You can also cover your position and just stop trading. Just remember that the market can throw unexpected opportunities in the form of failed setups, and they can be exploited if you are careful and disciplined about exiting losing trades and not flipping your trade's direction multiple times. Reading this might become confusing, and live trading is even more confusing. But what I'm trying to show here is the way of thinking and approaching the market. It is complex because of its size and the fact that every participant uses their own approach and is affected by psychological and financial factors. Find a combination of indicators that increase the probability of a price move and wait for those indicators to occur all at once. Keep it as simple as possible. If you have too many parameters, you will not have any trades. If you make too many trades, you risk bringing down the percentage of successful trades. Look at the chart of Apple stock. It has high volume and is making new highs on the daily chart. As a result, it is moving very well on the 2-minute chart as well. Notice how small the pullbacks are in such a stock. If you wait for a large pullback, you will not enter this trade at all. The ideal strategy is to trade only the highest probability setups and ignore everything else. When you are in a trade, your thinking is different than when you are analyzing charts. The moment you put on a trade, your emotions start nagging you to do something. And usually, it's the wrong thing to do. The less experience and discipline you have, the worse those actions will be. At the beginning of your career, minimize the decisions you must make while in a trade. Later, you will be able to add flexibility to your actions. But for now, just wait for the indicators to enter a trade. Identify your stop-loss price and take your profits when the price moves in your direction. I used to wait for a specific setup like an opening range breakout or pullback to a moving average. But after some time, I realized I was leaving money on the table by waiting for such a setup to occur. A large part of the move would already happen by that time, and I was left picking up whatever was left from that trade. I learned to enter such trades sooner. Sometimes I would put on a trade within minutes or even seconds of the market open, and the trade would explode in my direction, giving me great profits in minutes. But other times, when I picked the wrong side of the trade, my loss would be much worse as well. So once again, nothing in the stock market is black and white. There is no universal rule that guarantees you will always be right if you follow it. This is all just probability with many exceptions. You can learn to understand the market by just being in it. However, when you decide that you completely understand the market, you set up the grounds for failure. Such thinking will fail you every time. Visualize a perfect trade. I do not mean imagine. You should know it from looking at charts or from observing the market. You should know why the trade happened because you analyze the charts and data. What are the indicators pointing you to the perfect trade? These indicators are what you are looking for, and only them. If you have 3 indicators for entering a trade, you should not enter when only 2 of them are satisfied. It will dilute your odds of a successful trade. There are many setups out there, and most of them have a 50% chance of working out. That is what the market is trying to do. Stay as close to 50% as possible. You need to ignore all of them in favor of the setup where something happened that tilted the market. To use a metaphor, imagine a herd of bulls in a field. Your job is to pick a bull and plow some land. If you pick the right bull and he walks far enough, you get to plow a piece of land, which in our case equals making money. You cannot force the bull to do anything. On an average day, bulls are not doing anything. They stay in one place or walk short distances in random directions. You cannot predict anything consistently. If you try to plow using any of these bulls, you're simply wasting your energy, or in our case, you're trading capital and time. Imagine the bulls get startled by a gunshot. They pick a direction and the whole herd begins to run. Now your solution is more obvious. Pick the strongest bull and begin plowing. It is a lot harder and scarier to plow on a bull like that than on a bull who is calmly grazing. The same will happen with your best setups. Price will be moving fast and you will get a worse entry, but it is not going to matter. It will move further and faster than most traders will expect. Is it going to be scary to put those trades on? Yes. Will you have less time to think about what to do? Absolutely. You will be missing a lot of these trades at the beginning, and it is okay. Keep focusing on them anyway. 50% probability trades are easy to enter, but you do not want them. You want the one that is the hardest to get into. Situations in which the market is obviously tilted in one direction do not last because everyone hunts them, and such conditions are always trying to go back to 50% probability. To give you another metaphor, imagine sailing. Sailing is a lot more efficient during strong winds, but it is also more difficult and dangerous during such conditions. If you set your sails incorrectly, the wind can destroy you. It is the same with trading. You want volume and impulse in a stock, but if you get caught on the wrong side of that impulse, your situation can go from bad to worse very fast. Does trading have to be stressful? Everyone can develop a trading strategy that fits their personality. If you do not handle the adrenaline and speed of day trading, where a trade lasts minutes to hours, you can always switch your time frame to swing trading, where a trade lasts several days, or trend following, where a trade lasts for months. Warren Buffett was buying General Electric stock when it fell to around $5 per share. At that level, a lot of people had a hard time believing the stock was worth anything and was going to make a comeback. You must be ready to buy when blood flows in the streets. Those conditions will make you more money. You should not mistake such situations for days when things become too unstable. Just like you should not go sailing during a storm, you should not make trades when things are entirely out of control. If I were to think of an example of such days, it would be during the flash crash in the stock market in 2015 or during the short squeeze in GameStop stock. Such conditions can wipe out your entire account. If your trading software is beginning to freeze up because the system cannot handle the inflow of orders, it is a good time to stay out. How much money do you need to trade? Trading a small account will make correct risk management and emotional stability of the trader hard to achieve. When I first began trading, I traded a very small account because I just did not have enough money. I did it for years without realizing how it was hurting me. Correct risk management suggests that you should not risk more than 1 to 3% of your total trading capital on a single trade. If you risk more and have several losing trades in a row, which is a common thing in trading, your account will shrink by so much that you will either completely run out of money to trade or become stressed about running out of money. Being stressed about the capital left for trading is a sure way to lose money in the market. If you're familiar with playing poker, you can compare it to being the smallest chip stack at the table. Your chances of winning are very slim. It is the same with trading. If you have so little capital left that your next trade better be a winner, you are done trading. Even if you make money on your next trade, it is not going to save your trading account. I rarely had more than $1,000 in my trading account. My prop firm, who also provided leverage for my trading, would allow me to use some of the firm's money and go slightly negative, until I owed them about $1,000 before deactivating my account. A month later, I would deposit another $1,000 and they would let me trade again. And this went on for years. I would try to be very picky about my trades and trade with as small amounts as possible, but it did not make any difference. Scared money makes no money. If you are trading through a prop firm, your smallest trading lot is 100 shares. Let's say you're trading a stock the price of which is $75. It means that every penny the price moves, you make or lose $1. A stock like that will usually have about $3 to $5 daily range, the difference between the highest and the lowest price on an average day. The size of the pullback in such a stock will be from 25 to 75 cents. It means that depending on where you entered your position, the stock might move that much against you before it continues in the direction of the trend. You should set your stop loss so that the pullback does not make you exit the position. Let's say your stop loss is 75 cents away from your entry price. It means on a 100 share lot, you will lose $75 when you exited your stop loss. Your trading account size should allow you to have about 50 of such trades before you run out of money. It means your trading account needs to be $3,750 for you to trade comfortably. But this example considers an average daily range for the stock. The problem is that you do not want to trade the stock on an average day. You want to trade the stock when it is trading at a higher volume with more price volatility. Such stocks will give you a higher probability trade than a stock on an average day. Remember that volume confirms the trend, and without volume, the trend cannot be sustained. It also means that instead of moving $3 to $5 in a day, the price of the stock trading with high volume can move much further, $5 to $10 on a day with high volume. You want to capitalize on it. Such trades will make you more money, but the pullbacks will also be larger. You will set your stop loss further away so you do not get stopped out for no reason out of a good trade. If you concentrate on such trades, you will risk more per trade, you will make more per trade. The percentage of trades that work out will be higher, and there will be fewer trades for you to make because you added volume as an additional condition for entering the trade. If you increase your stop loss to $1, your minimum size trade will cost you $100 when it does not work out. Your trading capital must be at least $5,000 in that case. If you add slippage costs when you get a worse exit price than you expected because of high volatility of the stock, trades that you did not exit at stop loss because of poor trading discipline, your trading capital needs to be even larger. Several times, I lost over $1,000 on a trade where my stop loss was supposed to be only $100. I sat and stared at the price running away from me in disbelief. Account and commission fees, just account fees alone for the software and price quotes have gone up to almost $500 per month in recent years for day traders. You realize that you need an account closer to $10,000, and you should keep in mind that this account is calculated based on trading the smallest lot size possible. It means that if you risk $100, on average, you expect to make double, $200. You make 2 or 3 trades per week, since now you're only picking high volume trades and they do not happen every day. It means you might make 10 trades per month. 10 trades per month times 200 per winning trade equals $2,000 per month. If the percentage of your winners is 75%, you should expect to make $1,500 per month. From this amount, you need to subtract commission and account fees. You realize that your expected monthly earnings are dropping below $1,000. This is why I doubt the legitimacy of trading coaches saying that you can turn $500 into much larger sums trading stocks, as the stock market is a place where billion-dollar accounts fight for pennies with the help of sophisticated computer algorithms. It is the same as saying that I won a Formula One race in my Honda Civic. Think carefully when deciding how much money to trade with. It will influence your results in every single trade. How to flip positions. Flipping a position is a term that describes closing the position that is not working and quickly entering it in the opposite direction. The idea of flipping positions is mentioned by a few traders, but they never go into much detail about it. I realize that there are times when you should and times when you should not flip a position. I will give an example of 2 different setups. In one of them, flipping the position makes sense, and in the other, it does not. Look at the TAL stock in the image. It opens lower with heavy volume. You open a short position, but it fails to go lower and begins to move up fast and with volume. You cover at your stop loss. If the stock is continuing its reversal to the upside, you can flip it. Buy and open a long position. The conditions that you need to do this are reversal with large price swings and heavy volume. The stock needs to have fuel in the tank in the form of volume to warrant position flipping. Now think about another example. In this chart, the Facebook stock you enter refuses to move in your direction. It might take you out at a stop loss and then slowly continue in your direction. You notice that the volume is beginning to dry up, price swings are getting smaller and slower. The stock might stop trending and begin to trade sideways. In a situation like that, do not re-enter the stock. This is a fake breakout. The trading volume is low. Trading it can be very annoying and costly. This is a situation where you will need your discipline. Just stop trading for the day. As a rule, you should only flip the positions in exceptional situations, when the stock is figuratively speaking exploding. You must be extra careful in such stocks in general. If you miss your stop loss and decide that it will give you a chance to cover at a better price, you might incur a staggering loss. The more explosive a stock is, the more dangerous it is to trade, even though it is the only way to trade high probability setups. They're always harder to trade. Imagine the strength of an animal you're trying to tame and ride as a metaphor. You do not pick a donkey if you want to cover a large distance quickly. Always choose the stallion of trade setups. How to read the tape. Understanding the last sale tape is an important skill which can help you in picking the direction of the trade as well as timing the entry into a trade. Reading the last sale tape refers to watching the last trade prints to understand which side, bulls or bears, has an advantage. It is not a straightforward rule, like everything in trading. If there was a definite way to know which way the market is going, it would be quickly exploited and it would simply disappear as soon as enough traders figured it out. Your goal is to keep looking for clues and indicators pointing to the direction in which a trade might develop. Not all trading software allows you to see the last printed trade in real time. Most retail platforms do not offer this option because they are not built for day trading. It allows the company to bring the cost of the trading platform down, but if you are serious about day trading, being able to see a real-time sales tape is of paramount importance. To learn how to read the tape, sit down comfortably in front of your screen at the market open. Pick a stock which is trending with high volume and simply watch the last trade prints run. Remind yourself to breathe and stay calm. Do not pick any sides to test if you guessed it correctly. Just sit and watch it for 20 to 30 minutes. It's not as easy as it sounds because you will be distracted by so many things, including your own thoughts. Achieve almost meditative state. No thoughts, no emotions, no looking at other stocks. Just watch the price of the last trade bounce up and down like a ball. If you catch yourself getting anxious or emotional, wishing you had put on a trade 5 minutes ago, just observe that thought until it disappears. Go back to watching the last trade price. This exercise is very important for a trader. This is how you learn when to enter and when to exit trades. Do not practice this on a random stock. It will not give you enough information. Observe only the stocks that have volume and direction, meaning they are not trading in a range and are trending. In such scenarios, there will be a winning and a losing side of the trade. If the stock is moving up, the bulls are winning and the bears are losing. You will see how the last trade price behaves. It will have a similar dynamic to a more physical action, such as a bouncing rubber ball. If you notice, I have been using metaphors through this course because the stock market is a complex idea. It is difficult to understand without comparing it to things we are already familiar with. Nikola Tesla said that if you want to understand the world, think of it in terms of waves. Everything around us behaves like a wave. Things go up and down. Prices go up and down. Your strength as a biological organism goes up and down on an hourly, daily, or lifelong cycle. The more you learn to see the stock market as a giant ocean with billions of waves and tides, the better. Pay attention to how the price is changing. You might be inclined to just look at the chart because the chart shows exactly that, the change in price, but it is not the same. The chart only shows the marks in the sand of where the price was, and it is already in the past. It already happened. Watching the dynamic of the tape shows you the behavior of the market players, which is not visible on the chart yet. It might be difficult to process this information, but after watching it for some time, you will develop a gut feeling for who is stronger right now, bulls or bears. Let's look at an example of a stock whose price is falling. The price is not going to drop straight down. It almost never does. It will move up and down with consecutively lower highs and lower lows. Eventually, it will approach a level of support from which it will bounce up a bit more because it's the level where more people believe it is a good place to buy. The price will bounce up by 30 cents and drop back down to the support, and bounce up again, but this time bounce will be smaller, let's say 20 cents. It might repeat this cycle a couple more times, but eventually it will break through the support and drop to the next support level below it. Then the whole process repeats. The chart of the Navarro stocks shows exactly that. To understand this dynamic better, imagine a rubber ball which is dropped from some height onto a floor. You will see a similar behavior. Bouncing of the ball will have a similar dynamic. Bounces will be getting smaller and smaller until the ball just sits on the floor. But the price cannot just stop on the floor. So imagine that when this rubber ball stops bouncing, it just drops to the next floor below the first floor, and everything repeats. This is how stocks move. When the stock is moving up, the dynamic will be the same, but flipped. Stocks move down slightly differently than they move up, due to humans being prone to panicking when losing. Stocks usually fall faster than they rise. It also explains why bear markets are usually shorter than bull markets, but with larger price swings. At the beginning, you can assume that stocks move down the same way they move up. When you watch the tape, price movements become obvious. You will notice how after every time a stock bounces up, the sellers will step their offers down, lower the price at which they are selling, and the bounce will reverse sooner. After a few minutes, it might take you 3 to 20 minutes to develop a gut feeling for the price movement. You will feel like you know where the price is going to go next. Just keep in mind that you never really know for sure where the price is going to go next. But your probability of being right about the price movement in the next moment will go up. If you put on a trade at this point, it is no longer a 50% probability trade. It will tilt the odds of being right in your favor. This is the moment when you pull the trigger and enter a trade. By this moment, you should have aligned several indicators in your favor. The stock is trending. It is trending on heavy volume, so it has some gas in the tank to continue moving further, and you have timed the moment of entry by watching the battle between bulls and bears and hopped on the winner's side. Reading the tape will make sure you do not sell a falling stock right before it reverses for a correction and stops you out of your trade. This is what the tape is used for. When you are watching the tape, do not look for the specific pattern described earlier. It will be among other patterns, and if you only look for one, you will overlook other obvious setups. Clear your mind of the bull or bear bias and observe impartially how the price acts. Look for bounces that are getting smaller. Look for a wall-like seller or buyer that keeps advancing little by little without allowing the price to go through it. A big buyer or seller will not chase the price aggressively. Instead, he will step up his bid or step down his offer in small increments so they can build a bigger position without chasing the price away. Try to see the fight between bulls and bears as a war between two armies, and the price levels as the land each army is gaining or surrendering. Always remember that nothing is 100% definite in the stock market, and like in a boxing match, you must protect yourself at all times. It means that you must trade the correct size. Remember you might be wrong, and take stop losses if they are triggered. How to minimize and deal with losses. No one can trade stocks without losing money. If you trade high volume and high volatility setups, your losses will be bigger and happen faster. That is because you are trading a stock with higher volatility. It is like driving in a car at a high speed. You will get to your destination faster, but if you crash, it is going to be worse, and you will have less time to react. If you pick a poor setup, for example, a stock with no trading volume, it will be easier to exit the position because everything will be happening slower, and you will have time to analyze the situation and exit the trade if it moves against you. It doesn't mean you should trade such setups, though. The stock will not have enough gas in the tank to make you money. Sometimes the lack of volume might move the price faster because there are not enough traders to counteract large orders. This is also a situation you want to avoid. It is easier to lose a lot of money in a thinly traded stock. The price can run away faster than you can get out of the position. And this is another reason to trade only stocks that have a large trading volume on the day of the trade. Avoid thinly traded stocks to avoid large, uncontrollable losses. Let's focus on correct setups and exiting them correctly. If you are trading a high volume stock, the movement of the stock can be large and continue longer. It is a very good quality if you are on the right side of the trade, but it is dangerous if you are on the wrong side of the trade and the stock is moving against you. It has a lot of power to move, and now all this power is working against you. It means that you absolutely must exit the trade as soon as you realize something is not right. Look at the chart of WWE stock. It tries to move up but fails and falls. If you try to buy it at the open, closing this trade as soon as possible would be the best solution. Ideally, when you do everything right, the trade will quickly move in your direction and you will be able to take some profits or just observe the trade develop further in your favor. If, however, after you enter the position and expect the price to go up, the price suddenly reverses and moves down, moving past your stop loss, exit as soon as possible. In a situation when it moves so fast that you cannot exit properly and your planned loss of $100 becomes $200 or $300 before you can exit because the price moves so fast, take a larger loss and exit anyway. You will be tempted to wait, hoping it will pull back and allow you to exit with a smaller loss, but you should resist this desire to wait. I did not exit a trade in a similar situation over $100 or $200 loss, only to watch the stock rally so hard against me that I eventually got stopped out automatically by my trading platform when my loss reached $1,000. I lost $1,000 in minutes because I could not lose $250 instead of $100. You see the irony of the situation. I just sat watching it move further and further without any pullbacks. If you're a beginner, you must trade the smallest position size. It means that the size of your trade is small enough for you to exit instantly in any situation. A trader who trades a larger position, 10 to 50,000 shares and more, might have a harder time exiting the trade quickly, so it might make sense for them to wait a bit if the price moves sharply against them. Small traders should take their stop losses when stop losses are triggered. After you take your stop loss, you're not out of the woods yet because of how easy it is to re-enter a trade. You should also assess if you need to flip the position. This is where you need to figure out why your stop loss was triggered. Did you place the stop loss incorrectly and the stock resumed in the original direction as soon as you got stopped out? If that is the case, is there still volume? Look at the tape. If you were right about picking the setup and the tape is still going off like a machine gun, you can re-enter when you see a good entry. All you need to worry about is whether the stock still has the momentum and volume to move far enough to make you money. If on the other side you notice that the volume is dropping, stop trading or you will get sucked into a rope-a-dope where the stock seems to be toying with you. It will reverse and stop you out, then renew its original movement, you re-enter and the cycle repeats. If you flip the position, it will stop you out again and again no matter what you do. Your emotional state will quickly deteriorate, and you will find yourself flipping positions, re-entering again and again, only to accumulate a large loss for the day. The general rule, if the volume is average after the stop loss is triggered, do not re-enter. Look at the KO stock chart. It opens higher and tries to rally, but fails. The stock begins to sell off, but reverses again to the upside and rallies. Eventually, it reverses again and falls to the daily lows. If the volume remains heavy, but the stock reverses and moves hard against you, you can flip your position, given your emotional state is still stable and you find a good spot to re-enter. Look at the Philip Morris stock. If you flip your stock position at the open and buy instead, high trading volume will give you a great trade. Stop for a few moments and observe the tape. Get in unison with it, like a surfer gets to feel the coming wave. Avoid re-entering if something feels off. With every additional win and especially loss you take, Your psychological and mental composure gets weaker. Your ability to wait for the right moment to enter the position, your ability to wait for the stock to move in your direction and take profits at the right moment, as well as your ability to exit if the trade goes against you, all suffer. You can lose money even if the trade develops correctly. That's right. It is easier to lose money even in the correct setup when you're right about the direction of the trade. If you feel anything but calm and sharp when preparing for a trade, stop trading for the day. Do something else. Always think long term with trading. It is a lot easier to make back a $150 loss than a $1,000 loss. It is possible to lose any amount when trading stocks. Always remember that. Relatively small to your account size bets, placed on the best setups only, is the guarantee of long-term success. Always do a mental and emotional self-check before trading. Are you overly excited or nervous before even placing a trade? Are you telling yourself that you must make money today? Those are the signs that your mental and psychological states are not ideal. You want to feel neutral about putting on a trade. If there is a good setup today, you calmly enter and execute a trade, or take a stop loss and go about your day. If there is no good setup, you leave and go about your day. That's it. Trading should not be stressful or forced because you must make money every day, week, or month. Trading should be opportunistic. You trade only when the best conditions are present. The best conditions are rare. So if you notice that you must trade less and less often, it is a good sign you are becoming a better trader, and your results will show improvement. Profitable traders make fewer trades than the rest of the market participants, but their winning percentage is higher. Eventually, the account will become big enough to compensate for fewer trades. Combining technical indicators with intuition. The strategy defines what setups you trade. If you have well-defined rules for entering a trade and picking a stock to trade, you will not have to think whether you should put on a trade or not. Does it satisfy the conditions you defined? If yes, go ahead and get down to trading. If not, just get up and enjoy your life. Come back tomorrow. Almost no trading strategy has setups every day. Learn to recognize when there are no good trading setups quickly, and do not waste your life staring into the screen and losing your money on mediocre setups. The less time you spend on trading, the better results are going to be. Wait for situations when it's almost impossible not to put on a winning trade, so obvious the trade becomes. Such situations are not common, but that is why they are the best money makers. Be patient to trade only them. They often compare trading to art, since it is not as precise as engineering or mathematics. You will use strict rules for defining your trade parameters, like volume. But after you spend enough time watching the market, you will develop a gut feel for stock's behavior. That is your subconscious mind using your experience to help you decide what to do. I prefer to combine these two approaches in the following way. I use strict rules and indicators such as volume and considerable price movement to pick the stock I'm going to trade. Then, after I zero in on the stock, I try to clear my mind and begin to simply observe the tape. After some time has passed, this time will shrink as you become more experienced. I develop a feel for the movement of the price. I begin to see the levels where the stock develops weakness and reverses. Once you notice that you feel the price movement correctly, enter the trade. Such addition of intuitive entries to the rigid rules will allow you to enter the position in better spots, thus minimizing the possibilities of poor entries that require larger stop losses. Every movement has a pullback. Develop a feel for the strengths of the pullbacks and strike when the pullback fails. How to use technical analysis. Technical analysis is the recognition of patterns in price charts. It was developed long time ago, and there is a multitude of books and materials written on it. How effective is it in predicting the future price movements of the stock? I'm not going into detailed discussion of the technical analysis because there is so much written about it. As a trader, you should familiarize yourself with a couple of books on technical analysis. One of them is the Candlestick Trading Bible, It is an old book, but it is a classic. Also, do some research on the Elliott wave theory. Both are worth familiarizing with. Technical analysis connects the price movements to the behavior of traders. Understanding the behavior of traders allows you to better to predict what might happen next to the stock price. I learned that relying on price patterns is not a straightforward and guaranteed way to predict what will happen next. It's like looking at animal footprints in the snow. It will give you an understanding about what the animal has been doing, but it can hardly predict where the animal will go next. It's not a very reliable predictor on its own. It can help you with timing your entries and exits, as well as setting your stop losses. It can be a good confirmation indicator for everything else you do, but relying on technical analysis to trade will not give the desired results. In hindsight, no matter what stock you look at, you will always see one technical pattern or another. But you must remember that most of the time, stocks have a 50% probability of moving up or down, even though they're constantly forming technical patterns all day long. Every chart is filled with various patterns: consolidations, breakouts, double bottoms, double tops, and so on. There are dozens, if not hundreds, of patterns in every chart, happening in every time frame. There are constant clashes between patterns happening in different time frames. Your 5-minute chart pattern might be telling you to buy, but your daily chart will be telling you to sell. How do you know which one to trade? Do you look for the moments when the patterns coincide? Does it ever really happen, given how many different time frames there are? And when they do, what if the lack of volume just forces the stock to sit there and waste your time instead of making money? You might say that you will only trade when there is volume supporting the technical pattern, but often, by the time the technical pattern has formed, the volume is already dropping, and you enter the stock at the end of the movement. I used to trade a strategy where I would look for the stocks that were breaking out of the opening range, the first 30 minutes after the market opened, and then wait for the price to pull back to the 5-minute moving average for the entry. After a while, I realized that by the time I entered the stock, a large part of the move would already have happened, and I would be left picking up the last bits of the action. Other times, the stock would be so strong that it would never pull back to the moving average until it traded most of the volume and began to reverse. I would end up buying when traders who bought before me were unloading their positions. This is not a good spot to be in. Let's throw in a metaphor to simplify this concept. Imagine that each stock is a restaurant, and you are a waiter who can get a shift in any restaurant you want. Your goal is to pick a restaurant which will make you the most money in the shortest amount of time. You're walking down the street and looking at the restaurants, trying to analyze in which one to work today. You can look at the past data, which tells you how much money each restaurant made yesterday, last week, last month, or last year. Or you can simply look at the most obvious sign: how many people are at the restaurant right now. If it is crowded inside, you're guaranteed to make some money. Why should you care if the restaurant was empty yesterday or 2 hours ago? It is filled with people, so there is money to be made. Data about how busy the restaurant was before is equivalent to technical analysis and price charts. Does it guarantee that the restaurant will be full for the rest of the day? It might, but it is not a guarantee. But if you can see with your own eyes that the restaurant is filled with customers right now, you know that you are guaranteed to make some money. And this is what the trading volume of the stock tells you. You want to see many market participants trying anxiously to get in on the stock. They are the fuel that will push the stock price further after you enter it, and you want to be there as soon as possible. By the time the technical pattern shows you that there is strength in a particular stock, you might be entering it as one of the last traders left to pick up the remaining crumbs. This is why volume is the leading indicator, while technical patterns are the lagging indicator. They look better after the fact, when there is not much you can do about it. That is why no matter what strategy you use, volume is one of the most important, if not the most important, element in picking your trades. No matter how perfect and straight out of the textbook a technical pattern looks, If there is no volume supporting it, you will not make money in the long run. Just as easily as patterns form, they fail just as easily. For every technical pattern that works, there is a technical pattern that fails. It is almost useless to analyze charts without understanding the trading volume behind the chart. Absolutely identical setups will work out entirely differently because they had different trading volume. Learn to pay attention to whether trading volume is high or low. If you day trade, watch the last sale tape and movement of the bid and offer, and the way the price action behaves. You will learn to understand it if you watch it long enough. Just relax, pick a stock which is trading with higher than usual volume, and watch the last sale price change. Begin at the market open and watch it for a couple of hours. The next day, pick a stock trading with low volume and observe it for a couple of hours too. You will understand the difference between trading stocks with high and low volume. I'm not saying that this is the only way to trade. There are so many ways to trade the stock market, and you will develop yours. It will fit your personality. I trade the way I do because I do not have patience or desire to spend hours trading stocks. To me, it is a very game-like activity. This is why my strategy relies on trades that last from a couple of minutes to an hour or two. They also do not happen every day. In general, such trades occur from 2 or 3 times per week to 3 or 4 times per month. But since they work out 80% of the time, it works out better for the bottom line. Read a book about technical analysis. Understanding technical analysis is like knowing an opening game in chess. You will have an advantage if you know one, but it does not guarantee that you will win the game. Every stock is constantly developing some sort of technical setup. Once you have read a book on technical analysis, setups pop out everywhere. Using it to manage the trade instead of picking a trade would make more sense. When the trade is working out well, there is volume and the price is moving well. I will see obvious technical patterns along the price progression. There will be technical patterns in other stocks as well, but they will fail here and there. And those occasional fails will be enough to bring down your winning percentage. To you, it's an entire trade that failed because one of the technical setups failed. For example, imagine Tesla stock is moving up with heavy trading volume. You missed the moment to buy and the stock moved up significantly. You're slightly disappointed, but you look at the stock of Rivian, which is also an electric car maker, and notice that it is beginning to trend higher as well. You decide that since Tesla is moving higher, so will Rivian, and decide to buy Rivian because it looks like a safer trade. The price is moving a bit slower, it hasn't run up too high yet, there is a technical pattern showing that the price is going to rise, your logical stop loss is closer, so to you, this screams a low-risk trade. You decide to enter it, but it ends up not working out and you just take a loss. At the same time, Tesla, which you decided to avoid because it looked like a riskier trade at the moment, has by now taken a pause or a pullback and resumed its move up. All the technical indicators confirm this movement the entire time. You look back at the Rivian stock and notice that it is now again showing technical indicators which are pointing in the direction that you entered it in, and it is tempting to repeat the initial trade. You should never do it in such a case. The lack of buying volume that was the initial reason for failure is still valid, even if the stock formed a technical buy pattern. Ideally, you want to never trade a stock like this and always look only for the stock that exhibits the best behavior for your strategy. Other stocks will mirror the behavior of the winner, but will fail at one point or another and will hurt your bottom line. One of the most important skills to become a successful trader is learning how to find one correct trade out of 10,000 wrong trades. Use whatever indicators, screeners, and timeframes you need to narrow 10,000 stocks to just one. It's not a random stock. Figure out how to separate it from the rest, like a predator can separate a young or sick prey from the rest of the herd. That is one of the most important skills in trading. If you cannot pick them well enough, you will not have enough winners to make up for losers. How to design your own trading strategy. So how do you design your own trading strategy? Should you design your own or use someone else's strategy? I realized after years of trading that you will create and trade your own strategy, even if you borrow it originally from someone else. A strategy involves rules for picking stocks to trade, setups to trade, and entries and exits into the trades. A good strategy also includes capital management rules. Even if you decide to use a strategy someone recommended instead of your own, you will make a lot of adjustments to it as time goes by. Even if someone tells you their complete trading approach, some elements will be omitted, and you will trade different stocks and trades than the person whose strategy you borrowed. If you're an absolute beginner, you can start with someone else's strategy and then adjust it to better fit you as you develop your own trading style. The trading style you develop depends a lot on your personality. I have always been restless, and I never liked sitting in front of the screen for prolonged periods. This is why my trading strategy involves trading highly volatile setups right after the market opens. I'm rarely in the market after 10:30 a.m. I usually know whether I have a trade or not within minutes of the market opening. My strategy allows me to not waste time when the conditions are not good for my trading style. The downside is that my trades do not happen every day. Sometimes they do not happen even every week. It is important to know when your strategy doesn't work for overall trading success. It is more profitable to not trade in poor conditions than lose and then make it back. When you develop your strategy, understand which factors and indicators increase the chances of your trade working out and which factors diminish those chances. In my example, such an indicator is volume. When I decide to put on a trade, the volume of trading should be multiples of average daily volume, not just 50 or 100% more. I want the volume to be 5 times the average trading volume in that stock. Does it happen often? No, it doesn't. But when it does, the probability of the trade being successful goes much higher. I would rather wait for 2 weeks and then make a single trade with an 85% chance of success, instead of spending all day making dozens of trades and hoping that my strategy will have enough winners to compensate for 45% of losers. To me, the answer is obvious, because I hate sitting in front of the screen for longer than an hour or two. This was not so obvious when I just began trading. To you, it might be different, so you need to decide your own strategy. Remember one thing: there is a style of trading that works for you. If you figure it out, you will enjoy trading more. How do you develop a trading strategy? I will describe my process, and it will show you the direction in which you need to move. When I began trading, my friend, who had started trading 6 months before me, showed me what he was doing. His strategy involved finding a stock that had a big order on a round number price, for example, 200,000 share buy order at $25. If the price dropped from $25.50 to $25, we would post a buy order 1 to 5 pennies above the large order and expect the price to bounce up, allowing us to cover for a profit of 10 to 25 cents per share. If the price refused to go back up and began going through that large order, we would quickly cover our position by selling it to the same large buyer at $25. Our loss would only be 1 to 5 cents per share. This strategy is called front-running large orders because you run in front of a large buyer or seller, hoping that their large order will move the market in your direction and give you a good exit price guarantee. Since we only risked a couple cents and took profits at 10 cents, we had to trade many shares. It increased our commissions. Commissions are paid based on the number of shares traded, and in situations when we couldn't cover precisely at that large order because it was taken out too fast, our losses would be considerably higher because of the size of our positions. We traded 5 to 20,000 shares per trade, even though we were absolute beginners and traded tiny accounts. I began realizing that in such a scalping type of trading, I will lose to guys with better reactions, faster internet connection to the stock exchange, and especially to algorithmic trading bots. This style of trading was too fast for me. I decided to switch my trading strategy to something a little slower that would allow me to take profits of 50 cents to $1 per share instead of 10 to 25 cents. It meant I could trade smaller size, pay less in commissions, and not be punished too severely if I miss my stop loss by 10 cents when exiting. This change allowed me to prevent my losses from turning into much bigger ones. I began trading the opening range breakout strategy. You identify the stocks that are trading up or down, allow the range of the first 30 minutes to form, and when the stock breaks out of that range, enter the trade in the direction of the breakout. The downsides to this strategy were a lot of fake breakouts, as well as the fact that when a stock is in a powerful trend, it might not even form a range. It will just power in one direction without any major pullbacks. Also, by the time I would enter the trade, the stock would have been trading for 45 minutes to an hour and was due for a pause or a pullback. So my entries were often at the very end of the move for the day because stocks often reach their high or low between 10 and 11 o'clock, using the rest of the day to digest this move. Notice in the GDS stock chart, the stock did not break out of its opening range until approximately 11:30. You would be entering this trade right before the lunch break, and it is usually already too late. I tried to switch from trading the opening range breakout to trading from moving averages to make sure I can enter the stocks that are moving very fast in one direction. Notice how the WDC stock in the image pulls back until it touches the moving average. Moving averages are the thin red lines on the chart. Such runaway stocks are the best to make money, but they do not like pulling back because everyone wants to be in them so much. Since everyone wants to be in it, the pullbacks are smaller than in other stocks with less supply-demand imbalance. I adjusted my strategy some more and decided not to wait for 45 minutes to enter the stock at the end of its move, but instead to enter it as soon as I could at the market open. Look at the price chart of the band stock. You can buy it right at the open instead of waiting for 10:30 to enter it when it pulled back to the moving average. But how do you decide which stock to trade and in which direction to put on a trade? The stock picking part turned out to be straightforward. Pick the stock with the volume that is 3 to 10 times its average daily volume at the stock market open. I want to see the stock trade millions of shares before the market opens. This tells me there is broad market interest in the stock today. It would also have to move up or down before or right at the open. This tells me that there is an imbalance in supply and demand. Technically speaking, a stock might have a large volume of buyers and sellers, and even though the volume is high, the price will not move far because there was equal number of buyers and sellers. Notice that Lulu stock cannot break out of its opening range on this chart even though the volume is high. Now that I have picked the stock, I need to pick the direction of the trade. By default, the direction of the trade is the direction of the trend or price movement at the market open. If the stock is up at the open, as is the case with the PVH stock in this image, I'm going to buy it. However, if the stock stops me out after I enter and begins to point to a reversal, I will often reverse my trade as well and short it. I only reverse my position once. If it stops me out again from a short position and begins to move up, either there is no obvious trend in this stock, no obvious supply-demand imbalance, or my ability to read the tape and price action is not at the level needed today. At this point, I need to assume that every trade I make today has a 50% probability of success, and I stop trading. After many years of trading, I realized that I do not need to wait for a perfect technical pattern to enter a trade. Once I identify that there is a stock to be traded, I can enter the position almost immediately at the market open. I watch the sales tape to identify an entry. You can do it as well, but keep in mind that tape reading takes a bit of practice and you can instead use candles, previous highs or lows, support and resistance levels to enter the stock with a good stop loss. Watching the sales tape also works best at the market open when there is a heavy volume of trading. Once trading slows down, trying to read the sales tape to predict the price direction becomes impossible. This is how my strategy evolved over the years. Can you take it and trade it? Absolutely, but I'm sure there are small details and indicators that I forgot to mention or do intuitively and your results will not be the same as mine. You will figure out these details and rules yourself if you analyze your trades. Ask yourself if the stock was a good pick. Were there other stocks that worked out better? How can you pick the stock that worked better than yours and avoid picking yours? Write down your ideas and theories. Test them out. Continue to constantly work on your stock picks. Remember that most of the time, most of the stocks are not doing anything. They're not trending. They have a 50-50% of winners and losers. Learn to stay away from those and only pick one winner. That is all you need. One trade setup with an 85% probability of success. Always remember that you need volume for the stock to move. It does not matter up or down. It still needs volume to move. If this paragraph became confusing, it reached its goal. All I want you to understand is that there are millions of strategies to trade the market. Pick the one that fits your personality. Learn the market conditions in which that strategy works better, and learn to execute the trade when your strategy tells you to. As a metaphor, imagine surfing. You need to know what day to surf so the waves do not kill you. You need to know what beach to surf at. And then you need to sit and watch the wave come. And when the time is right, you hold on to your board and you ride the wave. How to handle psychological effects of trading. This is a very exciting side of trading. Since the idea of trading boils down to getting paid for holding risk, being at risk is what you are ultimately getting paid for when you are trading or investing in stocks. Our biological bodies have a very distinct reaction to stress caused by being at risk. Expect to feel stress every time you trade. You will even feel stress when you think about trading. Notice your heart rate accelerate. You might hold your breath longer. Your neck and back muscles will get tense. This is the natural instincts in you responding to perceived danger. All those reactions are unhealthy and unpleasant, but this is the value that traders bring to the market. If you want to trade, you will need to learn how to minimize the stress. You do not want to trade when you feel stressed. It might be your gut telling you that today is not a great day for you to trade. I would strongly recommend listening to that voice. It is like a newbie surfer looking at 20-foot waves from the beach, thinking it's a good idea to come back another day. You should listen to your intuition when it tells you to take a day off. Do not trade stressed, tired, hungry, angry, scared. There is a losing trade waiting for every one of those trader groups to make. There is usually just one best trade. Sometimes there will be no trade at all. Just wait for the best. This will minimize your stress level. Higher probability setups lead to more winners and fewer losers. It means less stress. Less time holding a losing position means less stress. Less stress leads to better trading, and so on. Trade like a reptilian hunts. An alligator can just float in water for days without movement, but in one thrust, it can kill its prey and will be fed for days. This is how your trading strategy needs to be compared to an average trader. Be more selective than the rest. Preserve your energy and capital. There are people who are good at handling stress from risk exposure, but they're unicorns. Most of us are horrible at handling stress physically and psychologically. Always keep a check on how you're feeling. If you're nervous and tense, and you're thinking of entering a trade, I would recommend either making it a smaller trade size or not making it at all. The feeling when you're about to put on a trade should be, I can't afford not to make this trade, it's so obvious. I need to be prepared to act when I see the moment for entry. Knowing which trades are the best will come from experience, but you can also just go through the charts of the best trades for your strategy and find the indicators that separated them from the ones where your strategy did not work so well. Do not trade hungry or after drinking a lot of coffee. Try to be as calm as relaxed as possible. Your adrenaline will do the rest when you begin trading. If you trade less often, hopefully by the time you become nervous, you're already in the position and they're either in the money and can relax and start taking profits, or you're about to exit a losing position. In either case, be a lot more reluctant to put on additional trades after your first trade as a beginner. Chances are you might be getting close to your tilting point, after which you only make emotional decisions regarding your position. You might not even be aware that you are there. You will simply tell yourself a made-up story about why you need to be in one more trade. Avoid such trades at all costs. If it is a trade you should have been in, why wasn't it your first trade of choice that day? You need to know the best looking setup for your strategy so well that you almost never miss it, and you never confuse it with any other marginal setups. Keep testing and improving until you zero in on your personal trading edge. Better setups mean better results and less stress. That is your goal. Excessive stress is also a good sign that you are doing something wrong. You need to start changing your trading if the stress level is constant and unpleasant. Play with different time frames. If day trading is too intense, try swing trading or longer term investing. Make your trade size smaller, so small that you do not really care whether the trade makes you money or not. You can afford a loss that small. While you trade, pay attention to your posture, neck, and back muscles. They shouldn't be tense. Breathing, remind yourself to breathe calmly. Heart rate, if your heart is racing, it might be time to clock out for the day. Of course, you will feel some exhilaration every day. Just learn to manage it and make fewer trades when you feel it stronger. Your best psychological state is up until you open your first trade of the day. Market timing and periods. Here is how I want you to think of the market time. Imagine that at the market open, or any time new information creates an imbalance in supply-demand, a stone is dropped into a pond. The stone creates concentric circular waves that begin to spread out. A similar situation can be observed on stock charts. Trades cause waves in price charts. If there are a lot of trades, the waves in price charts will be bigger and run further. Making a trade is like throwing a stone into a pond. You disturb the equilibrium and create a wave. And so does everyone else. If enough trades are made in a short time, the combined wave will be bigger and last longer. When the market opens at 9:30 a.m., you get your largest rush of orders for the day. This is your first wave, the Big Bang event. The size of this event sets the tone for how the stock will trade for the rest of the day. Keep in mind that even though I only speak about the size of the event, or the volume of shares traded, the price will only move if there is also a supply-demand imbalance. For example, imagine that you are a large buyer of ABC stock, and your friend is a large seller of the same stock. If you post a large buy order and your friend immediately fills your order by selling you his shares, the price of ABC stock does not move. But if your friend takes a day off, your order will move the price up by buying all available shares. The demand has increased because of your order, but the supply has remained the same. This imbalance will create a price movement which will have the shape of a wave. Between 9:30 and 10 o'clock, the market makes the first and biggest impulse. Usually the largest number of shares for the day is traded within the first 30 minutes of trading. After the first impulse, the price will pull back a bit and then resume in the direction of the original impulse, making new highs and lows. It will pull back again and so on for the rest of the day. In theory, it continues forever, but it will be lost among other waves and impulses. This is the mechanism that makes all price charts look like waves. You can see these impulses and pauses on the chart of NXPI stock. Notice that early impulses move faster than the ones that happen later in the day. There are thousands of waves in the ocean, moving in all directions, interacting with each other, canceling or amplifying each other. They're coming from all directions. But if you observe a wave created by a large ship that passed by you, you can see the direction and development of the wave, even though it is interacting with all other waves around it. And if you were a surfer, you would be able to surf that wave. This is how you need to think as a trader. Just because the price is moving up and down does not mean you can make money buying low and selling high. The problem with this approach is that there are too many waves and too many stocks, and most of them are too small and uncertain in their size and direction, just like the waves in the middle of the ocean. You need to find the wave that has been set in motion by a large event. like a large ship whose large wake will allow you to surf it. Look for an event that sets off such a wave. You can tell it by a large trading volume and price change. Such an event will move the price for a while, and if you enter a trade like this one, it will continue for some time, allowing you to make money. What will happen with every other setup without such an event causing it? It will be more unpredictable and will not move the price far enough for you to make money. A stock where there is no excessive trading volume is easier to manipulate for large traders. In such a stock, you will constantly find yourself trading failed technical patterns or having your stop losses triggered to take you out of your position. It will cost you money and it will drive you mad. Stock will sometimes move sideways, and you will simply waste time as they consolidate. Your successful trades percentage will be lowered if you take more of such setups, making it hard to stay profitable. You will continue seeing all the right technical patterns, but if you keep trading them, such trades will dilute your profits from one or two correct setups that you also managed to trade. Your first strong impulse will last approximately from 9:30 to 10 a.m., first 30 minutes of trading hours. The price will then retreat for a pullback or consolidation, depending on how aggressive the opposite side is. This period will usually happen between 10 and 10:30 a.m., second half of the first trading hour. After this, the original direction of the price movement will resume and continue approximately until lunchtime, 11:30 to 12 p.m. If you saw a stock open at $10 on heavy volume, rally to $12 by 10 o'clock, then pull back to 11 where you entered it at 10:20 a.m., your move will probably continue until 11:30 or 12 o'clock. Once you notice the slowdown of trading around 11:30, it is time to take a break, take profits, or stop trading for the day. The price will either pull back or consolidate during lunch hours and resume after 1 p.m. when traders return from lunch break. There are more or less three impulses in a trading session: 9:30 a.m., 10:30 a.m., and 1:30 p.m. All inferior setups will have failed versions of the pattern described above. I used to trade the second impulse from 10:30 to 11:30, but eventually I learned to spot good setups at the market open, and it allowed me to trade the first impulse, 9:30 to 10 o'clock, instead of the second one. The first impulse is faster and more volatile, which makes it a little harder to trade, but it also allowed me to trade less than 30 minutes a day and still catch large price movements. How to take profits. It is a lot more fun to take profits than to take losses. It means you will delay taking a loss and lose more, and you will take profits too soon and make less. Remember this because this is what you will really want to do. It is your subconscious mind talking you into sitting there and losing more money when you are in a bad trade, but then jumping out of the winning trade quickly because you were afraid to give up your winnings. But how do you decide when to exit? You should try to pick trades in which you can make 3 to 4 times the amount you risk. The number of trades that will make you that much is lower, but it is exactly why they're worth waiting for. Let's say your stop loss is $1 away from where you open your trade. It is the maximum loss you're willing to take on this trade. When the price moves in your direction $1, you can cover half of your position. This is your break-even point. Even if the remaining part of your position gets closed out at stop loss, you will not lose money on this trade. I would cover the second half of the position even sooner, most likely no worse than my entry price. Scaling out of positions is an especially useful method. If you cover half of your position at break even, the trade cannot lose you money anymore, unless you really mess it up. And you still hold half of your position if the trade really picks up steam in your direction. You can cover half of the remaining position when the stock moves another $1, and just keep chopping in half the remaining position as the stock moves further in your direction. If the move stalls or begins to show signs of reversal, just cover the remaining position. This is a more mechanical and simple exit strategy. It does not need much position monitoring. You can set limit orders and move on with your life. There is another way to exit a trade. Do some research on similar types of trades and find technical reversal patterns that signal a good exit point. I exit when I see a candle reversal on a 5, 10, or 15-minute candle chart. Look at the chart of the CTRP stock. You can see that you could stay in this position until around $42 price level if you waited to exit until either 5 or 15-minute candles low got penetrated. This can be done on any time frame. It works on charts where each candle represents a day, week, or month as well. If technical indicators tell you when to take profits, you will have to pay more attention to the process, but it will give you better results in the long run if most of the trades you take are well picked. There are monster moves in the stock market happening all the time. Anyone can trade them if they learn to spot them. You do not need to compete with black box algorithms. Let them beat you by 25 cents when opening your position, but then catch a $5 price move on the trade because it was selected right. Why trading should not become your life. There are many ways to trade wrong. If you find yourself developing strong unpleasant feelings about trading, losing money, obsessing about trading or money in general, it might be a sign that you're overdoing it. You might suspect what the problem is but be unable to fix it. Just slow down. Trade less often, trade smaller positions, take a couple of days, weeks, or months off. You are too close to gain the perspective you need. It will come. Trading less should be the ultimate direction as you move along your learning curve of becoming a profitable trader. Try to set up your life and trading in such a way that you are looking forward to making your next trade, just as much as you're looking forward to exiting it and enjoying the rest of your day, no matter if it was a winner or a loser. To feel this way, you need to approach it right, have enough capital, do enough research, have other things to focus on when you're not trading, staying healthy. Trading takes time to perfect, but you can decide how much risk you're comfortable with. Stay small at the beginning during the learning, and scale up when you have established a good track record and confidence. The beauty of trading is that it is so easy to scale. Unfortunately, it is also the reason it is so easy to lose any amount of money in a very short time. The question of balance is going to be specifically important if you want to be a successful trader. Just as gamblers can become obsessed with their gambling and let it ruin their life and relationships, most traders will have to go through a similar ordeal if they do not approach trading correctly. Keep adding hobbies to your life and do fun things on both down and up days. If you're not happy, trading will only make it worse.